Hi CA students, let's revise CA Final AFM Chapter 6 Portfolio Management. Practical question 24. Suppose that economy A is growing rapidly and you are managing a global equity fund, and so far you have invested only in developed country stocks. Now you have decided to add stocks of economy A to your portfolio. The table below shows the expected rates of return, standard deviation and correlation coefficient. All estimates are for aggregate stock market of developed countries and stock market of economy A. So the correlation coefficient is between the developed stocks and stock of economy A. Now we have this expected return, risk correlation coefficient, and the risk-free return also is given as 3%. Now we are required to determine what percentage of your portfolio should you allocate to stocks of economy A if you want to increase the expected rate of return on your portfolio by 0.5. Generally, if we find out the expected return of a portfolio, we will be doing the weighted average method. So weights on the portfolio multiplied by the returns of the respective stocks, and the summation of that will give us the portfolio return. In this given case, they are telling the current portfolio, if we increase 0.5 percentage, then what will be the ratio of the investment of these developed country stocks and stocks of economy A. So we need to know what is the current portfolio. Since they have already mentioned invested only in developed country stocks, so that means what? Their current expected rate of return is 10 percentage. So plus 0.5 percentage will be 10.5. Now this will be the expected return of portfolio. Now to achieve this expected return of portfolio, we need a ratio in which we will be investing in uh, this developed country stocks and then stocks of economy A. So which will be nothing but 10 into weight of 10 plus 15 into weight of that 15, which is nothing but the stocks of economy B, will be equal to 10.5. And since there are only two stocks are involved, let's say if the weight of the developed country is 50, then weight of B also will be 50 percentage. If it is 40, here it will be 60. If this one is 60, here it will be 40. So we can say that weight 2 will be equal to 1 minus weight 1. So applying in the formula, 10 into weight 1 plus 15 into 1 minus weight 1 will be 10.5. So it will give us the same results. And the weight is calculated as 10 percentage. So the weight of stocks of economy A is 10 percentage. The second requirement is what will be the standard deviation of your portfolio, assuming that stocks of economy A are included in the portfolio as calculated above. So using the above weights, we have to calculate standard deviation of the portfolio. As we solved in our previous problems, we'll be using A plus B the whole square approach, wherein A square plus B square plus 2AB multiplied by the correlation coefficient of A and B, wherein A square is nothing but weight of A multiplied by standard deviation of A the whole square plus weight of B multiplied by standard deviation of B the whole square plus 2 into same here A weight of A multiplied by standard deviation and weight of B multiplied by standard deviation multiplied by the correlation coefficient. That's what they have also given here. Since we know the weight of the stocks of economy A is 10 percentage, the balance will be 90%, right? So this is the A square portion and this is the B square portion. This is 2 into weight of A multiplied by mm, weight of A multiplied by standard deviation of A and weight of B multiplied by standard deviation of B multiplied by the correlation coefficient. So which will give us the variance of portfolio 0.02423, and if we take the root of 0.0243 will give us the standard deviation, which is nothing but 0.15565 or 15.6%. Now the third requirement is also show how well the fund will be compensated for the risk undertaken due to inclusion of stocks of economy A in the portfolio, comparing with the investment in developed country stock only. So they are asking how will the fund will be compensated for the risk undertaken. So to make this comparison, we should need to know how much per rupee risk the stocks are performing extra return. We can find that out by using Sharpe's ratio. So which is nothing but the expected return of the portfolio minus the risk-free return divided by standard deviation. So the expected return of portfolio minus risk-free return will give us the extra return which we are earning, and dividing it by the standard deviation will give us the per rupee risk return. So for every 1 rupee of risk, how much is the 1 rupee or 1 unit of risk, how much is the extra return we are earning from the portfolio compared to the risk-free rate. So in the case of only in developed countries, since our return is 10% minus the risk-free return which they have given is 3% divided by the risk, so 0.437% is the risk is the return, extra return we are earning for the per unit risk of developed countries investment. Then after including stocks of A, the portfolio's risk reduced, right, 15.6. This is because of the diversification, and the return is increased from 10 to 10.5. So 10.5 minus 3 divided by 15.6 will give us the per unit extra return which we are earning for the per unit risk. So which is nothing but 0.481%. Now as we can see, after including stock A to the extent of 10%, our per unit risk return, the extra return which we are earning, has increased from 0.0437 to 0.0481. So 0.481 minus 0.437 is nothing but 0.044. So that's what they have mentioned. The Sharpe ratio will improve by approximately 0.04. That's it. Thank you.